Hello, everyone. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. If this is your first time here, would love to have you be a subscriber. Click that subscribe button. Thank you. This video is being recorded on Monday, December 2nd, 2024. Hope you guys all had a great weekend and hope you have an even better week ahead. Let's get things started this week with Macro Mondays. And today I'm going to talk about something I've mentioned in past videos, and I've alluded to it from time to time. I've written about it as well. And that is why when we get the next bear market or recession or downturn or the stock market cracks, you're going to see precious metals move higher and not lower with the stock market. Now, I'm not necessarily talking about the negative correlation for every day or every week or every month, but the next time we get a bear market in the stock market, that lasts a year and a half, or 10 months or 8 months, whatever it is, we're going to see the precious metals rather move much higher as the stock market suffers. I'm going to explain why in this video. Okay, so the first thing to note is let's just remember the nature of secular trends between the stock market and gold. One is in a secular bull, the other is in a secular bear. So I've highlighted the secular bears here in the stock market. And we all know what happened. 2000s, great for gold and gold stocks. Silver as well. Same thing in the 70s and also in the 1930s. I put gold stocks here because gold, it was revalued, but we were under the gold standard. So you couldn't speculate or trade gold. Therefore, the gold proxy, or the replacement for gold stocks, did really well in the 30s. Now, we are having a bit of an overlap. I shouldn't say a bit. We are having an overlap now, and this happens a little bit from time to time because this 13-year cup and handle pattern, gold has broken out of it. And so it's hard to say gold is not in a secular bull with that breakout. But the stock market, it just keeps going up. It kept, recent years, it's bounced above or bounced at the 40-month moving average several times. Higher high. New all-time highs. It continues. It's in a secular bull. So, secular bull for the stock market, secular bull for gold, although it hasn't been confirmed yet based on the action in the 60-40. So, you have more of a real secular bull on the stocks, not quite yet in real terms with respect to gold. But in nominal terms, yes, it's a secular bull. So, similarly, we did see an overlap in the mid-1960s when the gold stocks made this huge breakout in 1964. But the stock market in the early 60s, from the early 60s to late 68, when the secular bull peaked, its gains really slowed down. Now, it still held the 40-month moving average, but its gains slowed down. Gold stocks really outperformed the stock market. So we have not seen that yet with respect to this time around gold in the stock market. So gold's broken out, but the stock market has still outperformed gold. Just pull up gold against the S&P 500 ratio chart. You'll know what I'm talking about. But here's the important point. So we have an overlap here. We have an overlap here. Now, we know that bonds are in a secular bear. They fell into a secular bear in 1965. So this is setting up for precious metals to begin a secular bull or to confirm it at some point. But yes, these moved higher together, like what's going on now. But what happened? You had the stock market, its secular bull ended, and gold and gold stocks and silver as well, then their new secular bull was confirmed. So there can be some overlap, but this fledgling secular bull in gold and the rest of precious metals, you could say, that can't continue or sustain itself for a long time until we get this secular bull ending. And I'll get to this point in another chart, but this chart is just to show you that, when people think about, the big gold declines of 2008 and the mid-1970s, remember, those were in the middle of secular bull markets. So a lot of money, a lot of investors were already positioned in precious metals, especially in 2008. Even in the mid-70s, gold had gone from 35 to 200. Silver from what, like $1 to $6 or something like that? So, again, a lot of money was in precious metals at that time in the mid 70s. But also in 2008, we can see here, even though ETFs, gold ETFs just got started, 2008, the previous years, I mean, this figure had moved up to, call it 6% from, 2004 to, had a huge breakout here. I mean, this was still really low. So a lot of money had moved in. Look at where we are now. Gold bottom here at 1050. But look, even here earlier this year before the breakout, the money in gold as far as the ETFs relative to all ETFs, this is the lowest since 0506. And this is where we are now. So this is where the peak was. We're not even sniffing a secular bull yet. So there's not enough money in precious metals to sell for there to be some big sell-off and big crash. So that's important to understand. It's just one thing to think about or to understand, both. Okay, next chart. Okay, so a lot here to talk about. Stock market here, gold stocks, Barron's Gold Mining Index, silver. Here's gold against the 60-40. Here's when we got the bullish signal from gold against the 60-40 portfolio. By the way, if you don't know, that's 60%. This is a portfolio of 60% in stocks, 40% in bonds. So again, big bullish signal here, big bullish signal here. And these signals occurred, well, this one occurred a little bit before you had the negative correlation here. And this one occurred, I mean, it started late 2001, but the negative correlation had already started earlier than that. But it continued. But let's go back and look at these. Well, actually, I will in the next few charts. But this was a 50% bear in the S&P. This is also 50% bear. But why was there a negative correlation? Why in this period and this period as well, why was there a negative correlation? Why did precious metals rise for much of these periods? Of course, it was more prominent here from 73 to 74 than 01 and 02, but gold stocks did especially well during this period. Why was it more prominent? Well, I think a big reason is because, when you're moving from a secular bull in the stock market over to precious metals, there has to be money moving out of the stock market and then into precious metals. I mean, the same thing happened when we think about after 2011 and then after 1980. After 1980, money was moving out of commodities and back into stocks and bonds. The same thing in 2011. Money was moving out of gold, silver, and commodities and slowly back into stocks. So, if we are to see, as we expect precious metals to move into or confirm a secular bull market, as they did here and here with gold outperforming the conventional portfolio, when this move happens, this move, it not only does it entail, but it requires some kind of negative correlation like this. Because when this happens, this won't just be gold and silver and gold stocks surging higher. Like, you're going to need to see money coming out of stocks and stocks declining and having a bear market to some degree. Because otherwise, the secular bull in stocks, it just continues. It continues and more money moves in. There's a correction, more money moves in. It continues. So until that stops, you don't see precious metals go into a new secular bull, or at least confirm it. And so I'll zoom in on these periods. So here, this was the 73 to 74 period. And by the way, this negative correlation that you see, this continued until 1978 because, yes, one of the downsides of this huge move in precious metals, while the stock market was crashing or falling or declining, again, one of the downsides is when the market and the economy recovered, gold and silver, gold got crushed. Gold went down 45%. Okay, the gold stocks went down 60%. Now, I think we could see something like that happen, but, not until the end of the decade, 2028, maybe 29, something like that. So that's the potential downside of this scenario. It was a little different around the turn of the millennium because, yes, you had the bear market, nasty bear market in the stock market. Then you had, of course, this was the bullish signal, late 2001, gold against the 60-40. Silver was kind of slow to move, but the gold stocks This is before we had gold and silver ETFs, so people bought gold stocks more so than gold. So they had a huge move. And interestingly, again, this is why this was a little different than the 70s. The stock market bottomed, or this was kind of a double bottom. Market moved higher, and precious metals still moved higher with the stock market. So that was different from the 70s. I know that's a lot to take in from the video, but the main points to think about are just look at this history and please understand that for precious metals to confirm a real bull market, you need to have U.S. stocks go into a secular bear. And so therefore this negative correlation between the two, when it becomes most pronounced, is at or around the beginning of this changeover. You know, it doesn't make sense that would happen in the middle. You know, that's not going to happen when gold is at 5,000. You know, it's going to happen sooner rather than later. And the final point is what I mentioned, you know, with the ETF chart. Look, all the money has gone into stocks and crypto. It's not going into gold. Okay, so there's in 2008 and in the mid 70s, precious metals had a great run for more than a few years. So everybody was invested in them. That's not the case now. So there's not a lot of selling power in these markets. So these are important things to understand. Okay, with that was a longer video than I wanted, but hope you enjoyed it. That's it for today's Macro Mondays. And I'll talk to you guys again later this week. And I hope you have a great week. And leave a comment. Let me know what you think.